Welcome back to our brand new Just the Data Comprehensive Economic Analysis. This is in our brand new Substack newsletter. We'll provide you a link in the description of the video as well. What we're going to talk about today is the business cycle, which oscillates between expansion and contraction phases. For the sake of simplicity, we're going to define the business cycle as one where we measure stocks, commodities, and bond yields on the daily closing prices. We're going to take you through each stage of the way. An uptrend, for simplicity's sake, exists in this case when the green line, crude oil, is above the 20 simple moving average, and the 20 simple moving average is above the 90 simple moving average. Conversely, a downtrend would exist if crude oil was at the bottom and the 90 simple moving average was at the top. Now, for example, we see here there are 6 different stages that exist, and we determine those stages based on the position of stocks, commodities, and bond yields. In stage number 1, stocks, commodities, and bond yields are all heading lower. That will transition to stage number 2, where stocks are first to reverse back to the upside. That's followed by stage 3, where commodities then move to the upside. And that concludes the contraction cycle. We then move to the expansion cycle of the business cycle, where all 3 markets, stocks, commodities, and bond yields, are all moving to the upside. That's followed by stage 5, where stocks turn to the downside, but commodities and bond yields are still pointing higher. And then finally, the conclusion of the expansion stage, when stocks and commodities are moving lower, however, bond yields are still moving higher. So let's take a look at some historical data. This goes back to August through October of 2023, just this past year. Now, we were at the time in a stage 4 phase where stocks, commodities, and bond yields were all moving higher at the same time. Notice in this case, the S&P 500, the green line, is above the 20 simple moving average, and the 20 simple moving average was also above the 90 simple moving average. During the same period of time, crude oil, the green line, was above the 20, and the 20 was above the 90. And then finally, we have the 10-year U.S. Treasury bond. The green line is above the 20 simple moving average, and the 20, again, is above the 90. So in all 3 cases, the market were above its 20 simple moving average, and the 20 was above the 90. Then we move on to stage 5, which occurred between September and late October of 2023. The green line in this case is the S&P 500, which we see cross back below the 20 simple moving average. The red line, which was in turn below its own respective 90. During the same period of time, though, the bond yields, the 10-year U.S. Treasury, remained above the 20 simple moving average, which was again above the 90 at that point. And during the same period of time as well, the crude oil market was still technically above the 20 simple moving average and the 90 simple moving average. Now, we know we look at this chart and it's not a very pretty bull market, but for the sake of defining these trends in the most objective and consistent way possible, we want to find those periods of time when the market is above the 20 and the 20 is above the 90. So technically, we still were at this point in an uptrending market in terms of crude oil. However, we can see we moved to stage 2. If you recall, the last stage was stage 5. You may ask, well, we skipped 1, and that is correct. Stage 2, we moved to a point where stocks were trending to the upside, but we can see here commodities, crude oil, was still below the 20 simple moving average, and bond yields were also below their own respective 20 simple moving average. At this point, we can see, though, the S&P 500 was trending higher. Now, it's not written in stone that we're going to follow this cycle, consistently throughout. There are periods of time based on the economic calendar or, outside forces which may change this market. In this case, we did skip stage 5, where or stage 6, we should say, if that had actually happened, we would have seen stocks in a downturn. And we can see here again, stage 4 occurs when all markets are moving to the upside. Stage 5, stocks turn first back to the downside. And then stage 6, commodities follow. However, given where we are now, What can we expect moving forward? Well, perhaps we would expect commodities to turn back to the upside. You see, right now we're technically in stage two because commodities are moving lower, bond yields are moving lower, but stocks are moving higher. The next logical move would be for commodities to move to the upside. However, let's say that doesn't occur. Let's say instead of commodities going back up, stocks turn back to the downside. Well, that would reset us back to stage one. So there's no guarantee that we're going to follow the cycle at all times. But the principle really does hold true, and it adds a lot of value in the sense that we can understand the correlations and what's happening. You see, the science behind this is very simply that stocks tend to move first because stocks are comprised of, you know, corporate earnings and cash on the books, and stocks tend to act as a leading indicator. When the stock market expands and there's more demand for raw materials, that's when commodities go up. And then finally, as economic expansion takes place, then we see the anticipation the Federal Reserve will raise interest rates to stem inflation, and that would lead the bond yields higher. Our analysis was gathered from sector rotation analysis at the chart school, stockcharts.com. We're going to provide you a link to this article. It's a very interesting analysis. We'll provide the link in the comments as well. If you'd like to read the full analysis, which is actually really quite interesting, please visit our brand new newsletter at substack.com. You don't have to be a member, you just log in right over there. And you would search for us, just the data. Make sure you use the underscores, just underscore the underscore data, and enter it right in the search bar. You can also click to subscribe if you like as well. Also, please visit our Twitter page where we provide updates throughout the week. We hope this has been helpful. We look forward to seeing you back soon.